Let's take a look at what's happening in the marketplace. Anthony Scaramucci is with us this morning, trying to understand these markets from Skybridge Capital, of course, and a CNBC contributor. His latest book is titled The Genius of Algorand, Technical Elegance and the DeFi Revolution. It's available in stores now. Anthony, help us understand, what do you think is happening here? So we're looking at green on the screen, and yet we keep hearing all this bad news. And I just wonder whether it's this sort of perverse sense that maybe the news is so bad that maybe the Fed decides that they don't have to make it worse.
So, Andrew, one of the things that we look at, which I was pointing out to your producer, Max Meyer, is the long-term break-even inflation rate on the tips. And so if you look at the 10-year tips right now and you look at that implied inflation rate, this morning it was at 2.24%. And so back in March-April time period, it was trending closer to 3. So that basically means that the market is suggesting that long-term inflation would be 3%. Obviously, the Fed didn't like that in March and April in that time frame, and so they moved aggressively. But today, it's at 2.24. Yesterday, frankly, it was at 2.15. As it trends closer to 2%, which is the long-term goal for the Fed, they get very nervous because they don't want it to go below 2, because one of the worst things that could happen is a deflationary crisis that would be bad for the United States, bad for the world. And so what I think is happening right now, the bond market is sensing that we're getting to the end of the Fed rate hikes, and I think that's why you're seeing a lift-off in these markets.
So I talked to a hedge fund manager last night who was saying, look, I think it's not 75 basis points. I think it's 50 at this point, and that's why things are moving higher. You agree with that?
I do agree with that. I think they probably move one more time. And frankly, if it is 75, I think the market actually moves higher because that's really the finishing point. 50 would be good as well. But again, remember, deflation is the worst possible thing that can happen to a debt-laden economy, because what happens is wages go down, but your debt stays constant. So just imagine the average household, they're making $60,000-ish a year, and they're carrying about $200,000 of debt. So suppose their pay goes down, it becomes impossible to service that debt. That happened in the 1930s, and you saw a real economic collapse. The Fed definitely doesn't want that. They're willing to take some inflation to avoid that possibility.
So, Anthony, throw in the possibility, or hopefully not the possibility, but throw in the mix just the gauge of fear that people have about the markets. We woke up on Monday, a lot of people are worried, for example, about Credit Suisse. Then they thought there could be knock-on effects to Deutsche Bank. How do you put all of that into the stew? And even throw in, Australia's central bank this morning, rather than going 50 basis points, only going 25.
I think they have to be worried right now. I think they learned something from the Lehman Brothers debacle. Everyone says in the market, oh, they're waiting for something to break. I honestly don't believe that. I think they want you to get to the point of breakage, Andrew, but they don't want something to break because it always has untold catastrophic consequences. The downfall of Lehman Brothers, I think you even wrote about it in your book 10 years ago, it probably contributed 200 basis points to the unemployment number, which was totally unnecessary. So hopefully we've learned that lesson from the global financial crisis, and they'll start to peter out on these interest rate hikes. Because the long-term trend, where the bond market, which obviously bond market knows everything. My old boss Bob Rubin used to say that. The bond market at 224 on the tips in terms of the real long-term inflation target for the tips, I think that's enough for the Fed not to go below 2.
Throw in crypto into this conversation. So we're looking right now at Bitcoin closing in, I want to say, about 20,000 again. Is this just simply risk on, risk off? That's the only way to look at it?
I think so, Andrew. Until the SEC and the CFTC and the legislature moves to create more clarity in the regulation around crypto, it seems like it's conjoined to the NASDAQ and other risk assets. I will point out, though, last month, I think Bitcoin was down about 3.7%. The overall market was closer to down 10%. So it did a little bit better last month. At some point, I do predict you'll have a decoupling, but it won't be until you get regulatory clarity. And so with the market up right now, it's not surprising to me that Bitcoin and things like Solana and Algorand, et cetera, are moving.
All right.